Hi everyone, good morning. So today we are continuing with leverage buyout advanced question and answers. This is episode 35 and my name is Deepak Vist. Let's get started. So today we are going to start with question number 10. The question number 10 is how would you adjust the income statement in a leverage buyout? And okay, so as of now we have not discussed about any adjustments. We have previously discussed about balance sheet adjustments, but now we are going to start with the income statement adjustments and how does a leverage buyout impact the income statement. And so this is here we will be basically covering how our income statement would look like when there is a lot of debt on the balance sheet. And if we have raised debt, what would be the impact on the income statement? So first of all, let's understand leverage buyout in simple terms. So, leverage buyout is when a private equity firm buys a company mostly using borrowed money. Uh, it's like buying a house with a mortgage. And after buying it, they try to improve the company, pay down the debt, and later sell it off for a profit. And because the ownership and financing changes, the company's income statement, which is also its a scorecard of profit, it actually needs to be adjusted to reflect this new reality. So, what adjustments are to be made on the income statement? And let's talk about this step by step. So, the first state, there are going to be operational changes where there would be a cost saving. So, simple idea is that the new owners cut cost to make the company more profitable. So they are going to do this thing. They are going to be operational changes, and there is going to be savings on the cost. And this might be like a new manager firing extra staff or finding cheaper suppliers. And it would show up. So where it would show up? So this would show up. It will reduce the company's expenses. So operating income goes up if we start saving our costs. And afterwards, the second point would be the new depreciation expense. So the simple idea here is that when the company is bought, its building machines and equipments might be revalued. So depreciation is the wear and tear cost spread over years, and it would again be shown in the operating income. And this would be a this would be the second step in the operational changes. So it would be impacting the operating income majorly. And the new amortization expense which would be created because of new depreciation, change in depreciation. So here the simple idea is that amortization is like depreciation only, but for non-physical things like brand names, patents, and financing fees. If the owner decides these things are worth more, the company slowly expands that value over time, and it would also show by reducing the operating income. And again, interest expenses in a leverage buyout are also a part of but they are actually a part of capital structure changes, not operational changes. So because there is a lot of debt involved in a leverage buyout, so there is going to be interest expense changes, and this is very obvious. So now the company has a lot of new loan because of the private equity firm borrowed money to buy it, and the company pays interest on those loans. And just like you pay interest on a mortgage, sometimes interest is cash paid now, and sometimes it's PIK interest. So which means you do not pay you do not pay it right now, but you add it onto the loan. And we have discussed about PIK in the previous question. So it could be any kind of loan, but there is going to be an interest expense, and it would show it's going to impact the pre-tax income on the income statement. And yes, interest expense does helps us by reducing the pre-tax income. And if we had debt in our capital structure, that it reduces the net income, and it also reduces the tax paid to the government also. So yes, that's pretty much it. And also the sponsor management fee. So the private equity firm sometimes changes the company for a fee for managing it, like paying someone to oversee your investment. So sponsor management fee, it would also reduce the pre-tax income. And just remember the treatment that this is going to expense out and there will be a benefit by reducing the pre-tax income. So pre-tax income before tax, this component will reduce and we are going to expense it out. So sponsor management fees. And after operational and capital structure changes, now we need to see the equity and hybrid security adjustments, which are after net income. So, okay, so understand this thing. So here the simple idea is that even if the company doesn't normally pay dividend, the private equity firm make the company take out a loan to give out cash to the owners, and that's called a dividend recapitalization. So common dividend and recapitalization. So they are going to take out debt and they are going to distribute it among the equity holders, the common dividend in recaps, and you subtract it from the net income, not an operating cost, but it affects the cash availability to the owners also. So we actually have to subtract it from the net income. Oh, sorry, you subtract it after net income actually. And just understand the definition of a dividend recap. So dividend recapitalization means that you are raising debt to pay off its shareholders so that at least they are booking some profit out of whatsoever money they have invested in initially. And from a preferred stock dividend perspective, here the preferred stock is a part of financing and it must make regular payments to those investors, which is similar to interest. So it's going to be subtracted from a net income to get the net income available to the common shareholders. But the most important thing is here the common dividend in the recap. So in this case, the dividend recap, the special dividends also reduce equity holders' return, though it does not hit the operating performance, but it does hit the equity holders' returns. And okay, let's discuss about this chart here, the rate card of the profit scorecard of the, which is also the income statement and how it's going to impact the income statement. So understand this thing. After cost cutting, okay, what does the cost cutting means? So spending less on employees and operations, and this is going to impact our operating income. Depreciation change. Depreciation is going to spread out the cost of revalued equipments, and this is going to increase our operating income. Amortization is going to, the definition of amortization is it will spread out the cost of revalued intangible assets and fees, and this is going to impact our operating income again. These are the operational changes. But if we talk about the capital structure changes, which involves the interest expense and the sponsor management fees. So interest expense, the interest on new debt is the cost of all the loans used to buy the company, and this is going to help us with the pre-tax income. And same goes with the management fee. The management fee, the payment to the private equity firm for managing the company, this is also going to reflect in the pre-tax income. It's whether going to increase or decrease, that we will actually have to see when we do a practical example. And after that, when we talk about the equity and the hybrid security adjustments, which are below the net income, so dividend recapitalization is cash payouts to the owners. But the recapitalization means that we have actually raised debt and we have then distributed that debt amount. So in the cash flow statement in the financing section, we have raised debt, we have paid out the dividends. So nothing there. I mean the all the changes nullify each other. But dividend recapitalization is an important concept in leverage buyouts. And this is going to show after net income. These are going to be after net income means and these are, even though these are not The income statement, these will not be reflected on the income statement, but these will be reflected after the net income. And preferred dividend means the payment owed to the preferred stock investors, and this will also reflect after net income. Mm, if you want a simpler analogy or a simpler explanation, think about it. Cost saving could be firing some of the staff. New depreciation means that you value the equipments and other uh, other company assets differently. The company's brand names or the other intellectual property rights. So there would be a new amortization onto that. And the interest, there is going to, you are going to owe the interest on the loan now. So there will be an interest expense. And you hire a consultant to advise you. So there will be management fees. And when you take out some dividend for you, you take out some cash for yourself. That's where the dividends come into play. This is a very good question. And the income statement adjustments. So whenever they are asking you about income statement, balance sheet, or cash flow statements, and how these three adjustments are, how these three financial statements move when any of the element changes. Though these questions are very tricky, but actually it would need uh, in-depth knowledge, and it will also ask you to think deeply. So I hope this is clear now. So let's move to question number 11 now. Question number 11 is in an LBO model, is it possible for debt investor to get a higher return than the private equity firm? So, is it possible? And what does it tells you or tells us about the company we are modeling? Okay, so let's understand the question first. What is happening here in this LBO? So, in a leverage buyout, the private equity firms put in some of its money, which is the equity, and it also borrows a lot of money from the lenders, which is the debt investors. And the company must pay the interest on the lender, and the company must pay the interest to the lenders and eventually pay them back. And think of it, uh, okay, a lot of house examples, but one more example. Let's think of it like buying a house. So you put in a down payment, which is the equity, and you borrow the rest through a mortgage, which is debt. So the bank earns interest no matter what happens to the house value, right? If you have experience with mortgages, so bank uh, does earns interest. So no matter what happens to the house's value, either it goes up, either it goes down, bank doesn't care. Bank, you actually have to pay the debt, or you actually have to pay back the debt, and along with the interest payments, which is the mortgage. Um, Now think about it. Can debt investor get a higher return than the private equity firm? So can a debt investor get a higher return than the private equity firm? And yes, it is possible, and it's very easily possible. So debt investors often earn around 10 to 15% interest per year, and this means that their return is almost locked in as long as the company doesn't fail completely. But the private equity firm, the return depends on how much the company grows and what it can sell it for. So the debt investors, the return is 10 to 15% every year in the form of interest, and they do not care about how the company performs. They the investors, the company is going to pay the interest anyhow. So, but the private equity firm's return depend on how much the company grows and what it could sell it for later. If the company doesn't grow much or even shrinks, the private equity firm's return could be very low. So the lenders may earn maybe less than 12%, while the private equity firm might earn uh, not even 5 or even 0%. So, and why does this happen? If you think about it, uh, So debt investors make money on a safer and more predictable way. So they get fixed payments every year. They get paid before the private equity firm, and as long as the company survives, they get their returns. So the and that's why debt is actually considered to be safer and more predictable. So if you are a credit analyst, you will be looking at different things, and if you are an equity analyst, you will be looking at you will be looking at different matrices. And the private equity firm's money is actually riskier. So its returns depend on the company's growing. If the company performs poorly, the private equity firms get little or nothing. And private equity investors also get paid after the debt investors. So people with less risk, with those are the debt investors, may get higher return than the people with more risk, the private equity firm. And this that's not common in normal investing, but in leverage buyout, yes, it can happen. And anything can happen in finance. It would there. I mean, it's there are a lot of factors which comes into play when we are calculating the returns, and real life factors also. In theory, things are different, and in practice, things are different. So yes, anything can happen. The in debt investors can generate more return than the private equity investors themselves. And what does this tells us about the company? So if this happens, so what does it tells about the company? So if debt investors get higher return than the private equity firm, so it would usually mean that the company did not grow as expected, and the final sale price was lower than planned. Also, the private equity firm took on too much debt, maybe, or the company is too weak or risky. So these are things. If you analyze the situation, so these could be the possibilities that maybe the company did not grow as expected. Maybe the final sale price was lower than planned. Maybe the private equity firm took on too much of debt, or maybe the company is too weak and risky. And in simple words, imagine you open a coffee shop. If you are opening any kind of shop, so you borrow money from the bank and you pay back the bank at 12% interest every year, or 10% interest based on your credit score. So now understand this thing. So you also invested some of your own savings. Even if the shop is barely break even, so even if your shop is just breaking even, or it's generating enough profit to support yourself, that's it. So you still own, you still have to earn. You actually, I mean, you still have to pay at least the interest amount to the bank, and the owner might take far less or even lose money. So that's exactly what happens in a leverage buyout. So in short, if lenders earn more than the private equity firm, it means that the deal were riskier or weaker than anticipated, and the equity value creation simply was not there. That's why when a leverage buyout happen of a company, so these all factors come into play: cost cutting, depreciation changes, amortization changes, interest on new debt, management fee, dividend recaps, and preferred dividends also. And this is a very vast field, leverage buyout. And this is not a very common event also, leverage buyout. If I remember, during the COVID phase, or when the market is in turmoil, these kind of things happen. During the COVID phase, there was a case where Patanjali actually bought Ruchi Soya, and we will discuss about this in detail when we will talk about leverage buyout models in detail. So let's save it for then. If you want, you can Google these things out. Google a recent case where uh, any company bought any company using leverage buyout. Any private equity firm bought any another company using leverage buyout. So yes. So let's move to question number 12 now. I hope we have cleared it out. Is yes, and it is possible. Everything is possible in finance. In the leverage buyout also, yes, debt investors can generate higher return than a private equity firm. Okay. So let's move to question number 12. So question number 12 is, most of the time increased leverage in a means an increased IRR. Explain how increasing the leverage could reduce the internal rate of return. And okay, so let's understand this question first. So, what does more debt usually increase? So, why does more debt usually increase return? Let's understand this thing first. So, think that you are buying something using borrowed money. So, if you are buying something using borrowed money, you put less of your own cash, and if the prices go up, your return on your cash is huge. So simply, relatively, if you are looking at the things that if you put 20% of yours and 80% was debt, so if things grow up, so as compared to 20% of your money, I'm not talking about the overall return, but if you think about it from your perspective, from equity holders perspective, so that would be much then relative. That will be much in relativity. So relatively, it would be more. So that's why when you're looking at financial ratios, you actually need to look in detail. That is why. So, yes, in practice, if we are thinking about it, it's just you might think that this is something nonsense if we look at the overall return. But when we are looking at the from the perspective of an equity holder return, so it actually that actually amplifies our return. So this if the company grows and you used a lot of borrowed money, your IRR all usually looks better. But sometimes adding more debt actually makes things worse. So this happens when the company cannot handle the extra debt. Means that more debt means higher interest payments, like higher monthly mortgage payments or higher monthly interest payments, and more principal to pay back means that the loan is getting bigger and bigger. And if these payments become too big, the company's cash flow gets squeezed. So this you need to understand that company's cash flow gets squeezed because you actually have to pay more out in the interest and principal payments. And this means that it has less money to reinvest in the businesses and pay down debt or to grow or to survive downturns also. So company always have a surplus amount of money to reinvest in businesses, pay down their debt, grow, or to survive downturn or the working capital requirements. And companies do invest in businesses. There is a different theory. Why? Companies do invest in different other businesses also, even sometimes in their competitors' businesses also. So as a result, the private equity firm can drop even though it used borrowed money. So these are the cases where the the IRR drops. In simple words, a person taking on too much mortgage means that okay, let's imagine that you bought a rental property with a lot of debt, and with a reasonable mortgage, rents cover all cost and you profit. But when there is too much mortgage, so your monthly payments are so high you barely break even or even lose money. And even though you are using borrowed money, you are not making higher returns because of the payments are overwhelming. And the same thing happens when a company is in is com a company is bought using leverage buyouts. And why adding too much debt can lower the internal rate of return? For this to happen, you actually need a perfect storm of three problems. Uh, Now understand these things. So why would too much debt can lower the internal rate of return? So for that, you actually need to understand these things. So there is a weak or flat EBITDA growth. So this means that if the company's profits stay flat or barely grow, it has no extra cash to deal with the higher debt payments. The second factor that could lead to lower the internal rate of return is high interest or principal repayment burdens. Yes, if the company is making um, I mean, let's understand, let's assume $100, but it owes $90 in payment, so it's barely surviving on $10. And this reduces the extra cash that's normally helpful to boost returns. And also, Maybe the because of a high purchase price or premium, maybe if you buy something expensive, it's hard to sell it for more later. So you already start with a lower expected return, and combine all these three. So debt and low growth, returns actually fall. High heavy debt and returns are low. So this means that returns are going to fall. Now let's put it all together and understand this thing. When does increasing leverage helps? So leverage will help us when the debt payments are the loan amounts are manageable, company is growing, and the cash flow is increasing. So this is the case when internal rate of return will go up. And when increasing leverage hurts, it's when the debt payments are too big, principal interest, high interest and principal payments. Company is not growing, the EBITDA is falling down, and cash flow is getting squeezed. And private equity firm cannot pay down debt or build values. So in these kind of cases, internal rate of return will fall. And if there is an ultra simple version, and if I can explain it to you, so understand this thing using the simple analogy that using some debt is helpful and using too much debt is dangerous. And just like a person using a small mortgage, which is manageable and financially smart, an overwhelming mortgage or a big mortgage is where monthly payments crush them and returns drop. And this same happens to companies that are in LBO. I hope this makes sense and this is clear now. So, question number 12, we have completed. So, with this, congratulations that we have completed the lecture series. And this is just the beginning to keep you curious, just to keep your curiosity alive. All right. So, I would request you to keep your curiosity alive, keep asking questions, and keep learning every day. And remember, knowledge grows when you explore, experiment, and challenge yourself. And the journey does not end here. Your potential is limitless. Go out, stay inspired, and make your ideas count. Keep learning and keep growing. With this, I would like to conclude the session, and I will see you in next series. All right. All the very best. Keep learning and keep growing.